Good afternoon, everyone, and welcome to our 2026 FBT briefing. In today's session, I will be providing you with an update to some of the FBT changes that have occurred during the year ended 31 March 2026. I'll also reinforce some of the key FBT fundamentals and help guide you through some of the tricky areas of FBT. And particularly, we'll focus on some of the ATO focus areas that we've noticed when they've been conducting reviews on our clients. My name is Ali Suleyman, and I'm one of the partners within the Tax Advisory Division at Pitcher Partners, and I head up the Employment Taxes Division. I will introduce my co-presenters shortly, but I would just like to encourage you all to provide any questions you may have within the dialogue box on our Zoom webinar. Time permitting, we will address these at the end of the presentation, but be assured that if we don't address them within our presentation, we'll respond via email or correspondence shortly. We have already received some questions from people ahead of the presentation, so thank you to all those that pre-submitted their questions, and we have tried to incorporate them as much as possible into our presentation as appropriate. You should note that this presentation will be recorded and made available to you shortly after, together with a copy of the slide pack and some of our other attachments that outline some of the key features that our team can perform and assist your businesses. In particular, we've included something on superannuation guarantee reviews, which is an area that a lot of employers will need to focus on in the lead up to 1 July as payday super approaches. Now, in terms of formalities, as we gather for this virtual event today and are physically dispersed, let's please recognise the various traditional lands on which we interact today. I wish to acknowledge the traditional custodians of the land we work and live on and pay respect to the past, present and emerging generations. So in today's presentation, I will be joined by Peejade Cheng, Elena Bogomolova and Gary Matthews, who are all extremely experienced practitioners that specialise not only in FBT, but in all the areas of employment taxes, including payroll tax, superannuation, work cover and POIG. For those of you that have attended these sessions before, our presenters should be very familiar to you and with multiple decades of experience spanning not only professional firms, but also within industry and within the state revenue officers or the ATO themselves. They bring experience across a wide range of areas. We'll take a more modern approach with our presentation style today, and I hope the new format will help make everything clear and a little bit more engaging for you all. So today's session is all about what employers need to know ahead of the 2026 FBT year. We'll start with what the ATO is focusing its compliance activity, because that's what's driving a lot of their reviews and the questions that we're seeing. We'll then touch briefly on the core FBT concepts, run through the key dates, rates and thresholds, and spend most of the time on the benefits that can cause the most issues in practice, particularly cars, entertainment and car parking. We'll then move on and finish with recent developments and some practical tips and traps to watch out for. Peejade, to kick us off, whilst there hasn't been much in the way of headline reform, we've seen the ATO becoming more active in the FBT space. From your perspective, what sort of activity have employers actually been seeing over the past year?
Thanks, Ali. So it's been a relatively quiet year from a legislative standpoint, but behind the scenes we can see that there's a clear lift in the ATO compliance activities, particularly in the small and medium enterprise space. The primary motivation from the ATO's point of view is that ongoing focus on the FBT gap, which according to the latest estimate has decreased to 30.4%. So that allows the tax office to perform more targeted reviews and audits using third-party data, such as information from our novated lease providers. And they're able to branch out to more higher risk areas such as novated leases and entertainment. And through these findings, generally what the ATO has found is not so much that employers are deliberately being non-compliant, but more so that the lack of understanding of the law or how the concessions and exemptions being applied. So, and also in terms of the gaps in record keeping. So whilst the legislation itself hasn't changed much, we've certainly seen a higher risk for employers subject to compliance activities from the ATO.
Great, thanks, Peejade. So Gary, just to get started on the technical side of things, could you give us a quick overview of fringe benefits tax and some of the key concepts we should have in mind?
Yeah, thanks, Ali. probably would be remiss of me not to mention the fact that FBT turns 40 this year. So happy birthday to FBT. Not that too many people would be celebrating that, I don't think. Now, let's look back at why it was introduced. FBT was introduced back in 1986 by the then Hawke Labor government, and it was introduced to address an issue where a lot of non-cash benefits were provided, especially to senior executives, and the income tax provisions were seen to be deficient and not able to adequately capture them. So basically they introduced legislation which would capture these non-cash benefits and tax them at the top marginal tax rate, and the employer would be liable for the tax. That brings me to the first real technical concept, and that is, what is a fringe benefit? Now, it's important that we determine if something is a fringe benefit, because then it becomes subject to tax. So in deciding that question, there's 4 steps. Firstly, has a benefit been provided? Now, there's quite a broad definition of a benefit, includes any right, privilege, service or facility, and it goes on. But it could include things like cars, paying expenses, loans, car parking, just the full gambit of benefits you might expect employers to provide to employees. Secondly, it must be provided by the employer or an associate of an employer or a third party under an arrangement. So you might have a situation where the employer and the person providing the benefit are not linked through ownership or whatever, but there is an arrangement whereby that third party will provide that benefit. So that can still capture that. Now, it must then be provided to an employee or an associate of the employee. So we're looking, say, when we talk about associates like spouses, partners, children, or other relatives, or even friends. And it must finally be provided in respect of employment. Okay? Now, we'll talk about that a little bit later, that concept of in respect of employment. But I just also want to say that we've got this definition of a fringe benefit, which includes all of those elements I've just mentioned, but there are some things which are specifically excluded from being a fringe benefit. And they include things like salary and wages, superannuation contributions to complying super funds, employment termination payments, and also contributions to worker entitlement funds. There's a whole range of things under the Act which are excluded, a lot of which are then taxed under other legislation, such as employee share scheme, are taxed under income tax rather than FBT.
So there are a few issues I'd like some clarification of. Firstly, does FBT define who an employee is?
FBT does have a definition of an employee. In simple terms, it basically says that anyone who is in receipt of a payment which is subject to PAYG withholding, including salary and wages and directors' fees, is considered to be an employee.
So Gary, a lot of family businesses have people like owners who don't draw a salary but may receive a benefit like a car. Can FBT still apply in those situations?
It sure can, Ali. The extended definition of an employee in the Act captures persons who may not receive salary and wages, but who do receive non-cash benefits such as cars, or certain payments may be made on their behalf, and it will effectively deem them to be an employee in circumstances where the benefit, if it had been paid in cash, would be considered to be salary and wages.
You mentioned that a benefit has to be provided in respect of employment. What does that actually mean in practice?
Well, in practice, essentially, we have to have a link between the employment and the employee receiving the benefit. Now, some case law in that regard basically talks about there being a sufficient and material connection between the employment and the receipt of the benefit by the employee. Now, we'll talk about that in more detail later today.
I noticed that the Act also breaks benefits into categories. Can you please elaborate on that?
There's 12 categories of benefit under the Act. Now, basically there's specific categories, 11 specific categories, including cars, entertainment, expense payment benefits, property benefits. And then there's one catch-all provision or category called residual benefits. So essentially anything that doesn't fall within the other 11 categories falls under residual fringe benefits.
And Gary, I've heard a lot about FBT exemptions.
Yeah, Ali, there's basically two types of exemptions under the Act. Firstly, general exemptions, which can apply to a range of categories of benefits. These include things like minor benefits, so a benefit with a value less than $300 provided on an infrequent and irregular basis. But it can also extend to things like exemptions for work-related items or certain benefits for relocation of employees, like removal and storage of household goods. So there's a general category of exemption, but there's also specific exemptions which may apply to only one particular category of benefit. An example of that would be in-house childcare facilities provided by an employer on the employer's premises and subject to certain other conditions. Okay, that doesn't apply in other cases. For instance, where an employer pays or reimburses an employee's child minding fees where they're provided by an external provider. That there is no such exemption for that. It only applies where the employer provides the child minding on their premises.
And finally, how do we actually value a fringe benefit?
Now, the most common way that they're valued is it'll be the GST inclusive cost of the benefit. But in some cases, we're unable to have or essentially determine what a cost is. So we'll use what we call market or notional value. So what a reasonable person would expect to pay for that benefit. There's also, under some categories of benefit, specific formulas. For instance, under car benefits, there is the statutory formula, and also under car parking, there's the average cost method to value the car parking benefits. Now, having determined what the taxable value is, there are also reductions available to reduce that taxable value. The first one of those is known as the otherwise deductible rule, and the second is reductions available via employee contributions. We'll talk about those as well later in today's session.
Thanks, Gary. So you can see we've collated some rates and thresholds on there for your reference. There was a reduction to the benchmark interest rate and a small increase to the car parking threshold, as you can see, but there's been no other changes to the FBT rates. So moving along to Elena, what are some of the most important dates employers must diarise for the 2026 FBT year?
Thank you, Ali. FBT year is different to income tax year, and it runs from 1st of April to 31st of March, so all benefits information should be collated for that period. The returns are due to be lodged with the ATO and payments made by 21st of May for those taxpayers who are self-lodging. If you're using a tax agent, you get an extension for lodgement and payment until 25th of June. All logbooks, declarations and elections should be on the FBT file by the time of lodgement of the return. Without declarations, exemptions or reductions may not be available. Also, reportable fringe benefits amounts are due to be reported on employees' payment summaries via single-touch payroll by 14th of July.
So why is it important to lodge an FBT return on time or to get an extension?
Well, it is important to lodge FBT return on time or get an extension to avoid late payment penalties. These penalties vary depending on the size of the employer. The penalties are particularly substantial for significant global entities. These are the entities with global turnover greater than 1 billion. For example, a penalty for a significant global entity for lodging FBT return just 1 day late can be as high as 165,000.
Well, we've received a lot of questions on car fringe benefits, so it's probably natural that we start with car fringe benefits. Providing a motor vehicle to an employee for private use will generally attract FBT unless an exemption applies, and the electric vehicle exemption has been incredibly popular. Peejade, at a high level, what do employers actually need to get right to access it?
Thanks, Ali. So at a high level, employers need to get 3 things right. First of all is the timing in terms of acquiring that or holding that vehicle. It must be first held on or after 1st of July 2022. The second part is the price of the vehicle. The first initial acquisition price for that vehicle must be below the luxury car tax threshold, which currently just sits just over $91,000. And lastly, it must be a car for FBT purposes. So it has to carry a load of less than 1 tonne or fewer than 9 passengers. So things like motorcycles, e-bikes, heavier commercial vehicles, they're definitely excluded.
So even where an EV qualifies for the exemption, are there still any flow-on impacts employers or employees need to be aware of?
Yeah, absolutely, Ali. And this is where both employers and employees often get caught out. Even though the benefit itself is exempt from FBT, you still need to calculate a notional taxable value to be included as reportable fringe benefits amounts. Now, it doesn't, from the employee's perspective, it doesn't mean that extra tax will have to be paid, but it will affect things such as Medicare levy surcharge, HEX repayment, or eligibility for other means-tested government benefits. Now, from an employer's perspective, you need to make sure that your payroll systems are set up correctly to make sure that these amounts are being reported through their single touch payroll or STP. There are also some practical cost consideration that needs to be discussed. For example, for those vehicles, luxury vehicles, you will have the depreciation capped, and whilst novated lease providers will be able to work that out automatically through their software, it may sometimes come as a bit of a surprise for employees. So employers do need to have that conversation before they decide to salary package an EV, especially the high-end ones.
Look, given Australia's EV charging infrastructure's taken a little bit of time to get up to speed, what I've noticed is that plug-in hybrids have been popular as a stepping stone into the EV space. What changes do employers need to be aware of in relation to hybrids?
Yeah, thanks, Ali. And this is a really important point. Plug-in hybrids are no longer eligible for exemption after 1 April 2025. There's very narrow transitional rules that you can navigate, and that's if you have a financially binding commitment prior to 1st of April 2025, and that's continuing in place beyond that date. And if the commitment changes, for example, if the lease is being refinanced or there's a change in employer and so forth, that you'll lose that particular exemption, and therefore your new employer or your current employer will have FBT exposure.
Which begs the question, what does financial binding commitment actually mean?
Yep, so it's on a very simple level. It's basically your lease or your finance arrangement does not change at all. So the problem here is that when there's a minor change could have a huge impact in terms of your FBT exposure. So it's probably worth getting advice before you make any of those kind of changes.
And I'm sure many of our clients will be very interested, but from a practical salary packaging perspective, what costs can be bundled into an EV arrangement and what tends to sit outside for FBT purposes?
In terms of EVs, it's not too different from an internal combustion vehicle. So things like expenses like registrations, insurance, service and repairs, those can be packaged. Where EVs will differ, it's in relation to electricity costs for charging the vehicle. The ATO has recently updated its guidance in relation to both EVs and plug-in hybrids. So that's something for employers to make sure that they get across, and no doubt that novated lease providers will do the same thing. Whilst those kind of operating costs can be packaged, there are several items that cannot be done, and it will be considered as separate benefits. So most prominently will be around the home charging stations. So even though you might have a Tesla, the Tesla charging stations will be counted as a separate benefit.
So with the price of petrol increasing as it has lately, the EV exemption seems to be even more important, and it feels like one of the more generous concessions in the FBT space. Peejade, do you think it's here to stay?
It's an interesting question. Treasury has commenced a statutory review into the EV exemption and looking how it has operated over the past 3 years. It'll look at how effective the concession has been and whether the eligibility criteria still works in this current setting, and lastly, how it interacts with the broader government agenda. So we would expect some changes to be introduced ahead of the 2027 federal budget, but the key message to the employers remains the same. There's nothing to be worried about at this point in time. In terms of the government changes, it's interesting to note that they've closed up the submissions to this review now. So I would imagine that they will be considering several options to be introduced and publicly consulted.
So, Elena, keeping on the theme of exemptions for vehicles, apart from electric vehicles, are there any other exemptions available for any type of vehicle?
FBT exemptions are available for certain work-related vehicles that are not designed principally to carry passengers and where any private use by the employees is limited. Common examples of such vehicles include single cab and dual cab utes, panel vans, delivery vans. The key idea there is that these types of vehicles are provided mainly to get the work done and not for personal convenience of employees. One of the common mistakes which we see is when employers are assuming that utes are always exempt without checking specifications or personal usage of the vehicles. Interestingly, there was a recent tribunal decision where a business provided Ferrari to its sole director. The tax office audited the business and issued assessments. Taxpayer objected and then referred the matter to the tribunal. In the tribunal, the taxpayer tried to argue that Ferrari should qualify for an exemption from FBT on the basis that it's not designed for principal purpose of carrying passengers. The taxpayer was not successful and tribunal rejected this argument. So now we know that Ferraris are not exempt from FBT.
I heard you mention that private use by employees should be limited, which kind of begs the question for me, what is an acceptable level of private use?
The exemption only applies if private use is minor, infrequent, and irregular. This is the term referred to in the FBT legislation. For the purposes of determining private use, travel between home and work is disregarded. Acceptable private use includes incidental detours like shopping for fuel or groceries, basically occasional non-routine use. Where exemption may fail is when there is a regular weekend use. Employees are using their vehicles for towing boats or caravans or for using them to go on holidays or for recreational travel. Once private use becomes regular and substantial, the exemption is lost and FBT will apply. To give employers some certainty in this space, the ATO issued Practical Compliance Guidance 2018-3, which provide safe harbor rules. Under this guideline, the ATO will accept a vehicle as exempt where total private travel is no more than 1,000 kilometers, no single private return journey exceeds 200 kilometers, the vehicle is genuinely work-related vehicle, and employer has policies restricting private use. So in those situations, the ATO will not devote compliance resources when vehicles satisfy this criteria.
So then, in your experience with dealing with the ATO and ATO reviews and ATO audits, what do you typically find the ATO expectation to be like in terms of documentation and record keeping?
Sure. If you're claiming an exemption for a vehicle, the ATO expects to have evidence that includes clear policy restricting private use by the employer, substantiation documentations, for example, employee declarations. And ATO expects that employers conduct reasonable monitoring or checks of private use and also have documentation supporting vehicle classification. So the key idea here is that FBT exemption is not automatic. It should be substantiated.
So in the alternative, then when the exemption does not apply, employers need to shift their mindset quickly and move from the exempt use of the vehicle or the exempt nature of the vehicle to valuation and management of their FBT liability. Can you tell us what some of the practical things employers should consider in this example or in this case?
When the workhorse exemption does not apply, employers must determine how should the vehicle be valued for FBT purposes. This depends on vehicle's load carrying capacity or payload. At that point, the vehicle should be treated either as a car fringe benefit or a residual fringe benefit. And the consequences can be different. So if a payload of the vehicle is less than 1 ton, the vehicle is a car fringe benefit, and car fringe benefit valuation rules will apply. If the payload of the vehicle is greater than 1 ton, the vehicle is not a car fringe benefit, it is a residual benefit, and residual rules will apply. This distinction is critical and often misunderstood by the taxpayers. Residual vehicle benefits are typically valued using operating cost or cents per kilometre method. There is no statutory formula equivalent here. Private use, such as weekend or holidays use or personal trips, drive FBT exposure. So record keeping still matters for residual vehicles. Where there is no legislative requirement to maintain logbook, employers still need evidence of business versus private use. It is also very useful to collect employee declarations for those vehicles. In case of car fringe benefit, employers may calculate the taxable value using statutory formula method or operating cost or logbook method. When using operating cost method, the employers typically need a logbook. Also note that when determining taxable value of car fringe benefits here, home to work travel is typically considered private use. If this is applicable to your circumstances, have a look at miscellaneous taxation rule in MT 2027, which talks about fringe benefit tax, private use of cars, and home to work travel. Employers should generally check both methods to determine which provides a better outcome.
So given car fringe benefits are one of the main categories of fringe benefit that all employers provide to employees, what are some of the key watch-outs for each of the statutory method and the operating cost method?
When applying statutory formula method, consider definition of base value and what it includes and excludes. Base value is inclusive of GST, luxury car tax, dealer delivery charges, and any non-business accessories, but is exclusive of stamp duty and registration costs. Base value can also be reduced by 1/3 when the vehicle is held for 4 full years by the beginning of FBT year, so by the 1st of April. There are some specific rules about trade-ins. If a vehicle was traded in by the employee, the value of the vehicle can be reduced. If a trade-in was provided by the employer, base value cannot be reduced. Also ensure that days available for private use are recorded correctly. These days can be reduced when the car is in extensive repairs or employee has taken an extensive leave and surrendered their keys to the employer. When you're using operating cost method, remember that to collect all operating costs, if a vehicle is owned, please remember that operating expenses should include deemed depreciation and interest. If a vehicle is leased, then lease charges should be included. It is important to have a logbook for this method. A logbook should be kept for 12 continuous weeks and can generally be relied on for up to 5 years, unless there is a change in the usage pattern. Inaccurate and outdated logbooks are major ATO audit risk. A question comes up from time to time if operating cost method can still be used if no logbook is available. The answer is yes, you can use operating cost method, but private use will be considered as 100%. I've seen a few rare examples when it was still advantageous to use operating cost method without a logbook. But typically, operating cost method provides a better value when business use percentage is above 65 or 70%. So just to wrap up, what are the common mistakes made by employers? First, assuming all utes are automatically exempt, failing to calculate payload correctly and therefore use correct valuation method. Not collecting declarations from employees to substantiate private use of the vehicles. If workhorse exemption fails, not having sufficient information to determine taxable value, and not reassessing vehicle status from year to year.
Well, I'm not sure whether the next area of FBT we'll be looking at will quite live up to its name, but here's hoping. Gary, can you please give us a bit of a rundown on entertainment benefits?
Yeah, thanks very much, Ali. No, I'm not sure it'll live up to its billing, but I'm hoping it will be informative. Yeah, so the first consideration with entertainment is what in fact is entertainment. So under the definition, we include both recreational entertainment and meal entertainment. But we also include accommodation and travel provided in conjunction with that entertainment. Okay, now when we break it down a little bit further, recreational entertainment includes things like social activities, leisure events, tickets to shows, or say a sporting event. Okay, meal entertainment on the other hand is simply defined as entertainment by way of food and drink. Okay, now when we consider meal entertainment specifically, one of the key issues there is in relation to what is meal entertainment as opposed to sustenance. So if something is sustenance, then it's generally not subject to FBT. So things like just giving someone a sandwich for lunch during a training session would not generally qualify as meal entertainment, would be sustenance. Okay, but if it's something more substantial, potentially it might be meal entertainment. Now, when we consider this issue, we look at a taxation ruling, TR 9717. And that gives us quite a bit of detail in terms of what can be considered to be meal entertainment and what is not. And in most of those cases, it'll be sustenance, not entertainment. Crucially, what you should consider are 4 questions. What is provided, when it's provided, where it's provided, and why it's provided. Now, if I can just go into those in a little bit. Firstly, what is provided? So if it's just a basic meal of, say, a sandwich and a soft drink, unlikely to be entertainment. But whereas if it becomes more substantial, like a 3-course meal with alcohol, we are basically saying that is probably entertainment in most cases. When is provided? Is it provided during work hours or after hours or on weekends? Now, normally if it's out of work hours or on weekends, it's more likely to be entertainment than it would be during work hours. However, it still could be entertainment if provided during work hours. Where it's provided also, so is it provided in-house in the office or is it provided externally at a venue? Now, in-house is less likely to be entertainment than if it's an external venue, but we still need to look at it further because there are clearly incident or occasions where in-house entertainment would be, in-house functions would be entertainment. And finally, the last question is why it's provided. So is it provided to sustain the individual, so provide sandwiches during a training session, or is it more substantial, trying to network? So we're at an event and we're trying to meet clients and we provide food and drink during that event. That's more likely to be entertainment.
So once you've decided that something is entertainment, what options do employers have in declaring and valuing the entertainment benefit?
Okay, Ali, there's 2 ways you can value entertainment. The first one is known as the actual method, colloquially known as that because it's not actually defined within the Act. And that can be categorised as property fringe benefit, expense, or even residual benefit. So one of those 3. Now that will depend on what's provided and who incurred the costs. It will determine which of those categories is appropriate. Now, having decided to declare on the based on actual cost, there are some exemptions that can be used to reduce the amount that you have to declare. And the first one, the obvious one, is you don't have to declare costs of entertainment in relation to clients and outsiders. Now, when we refer to outsiders, we're not referring to associates of employees because they still have to be included. It's only strictly clients and outsiders that we can exclude. Now, also, there is a specific exemption for food and drink consumed on business premises on a working day by an employee. So we can exclude those, notwithstanding that what is provided could otherwise constitute entertainment. And thirdly, if it's a minor benefit. So we provide entertainment, but the value per head is less than $300, GST inclusive, and it's provided on an infrequent and irregular basis. In those cases, we can probably exclude it if the employee is in receipt of similar benefits on not too many occasions during the year. And we usually use a benchmark of, say, 12 or less events would qualify as a minor benefit. Any more than that, we'd probably say the whole lot should be subject to tax. So that's basically the actual method. The second method is meal entertainment. And under this method, you've got two options. One is known as the 50-50 split method, and the other is the 12-week register. Now, the 50-50 split method basically says that you tally up all entertainment costs incurred during the year and you declare 50% of that, quite simply. The register method, on the other hand, requires you to maintain a register of all meal entertainment costs over a 12-week period, and you determine what percentage of those costs related to provision of entertainment to employees and associates. So you're excluding that provided to clients and outsiders. You're only going to declare the percentage that relates to employees and associates, and you apply that percentage to the full year's entertainment costs. Now, just a couple of points about those two methods, the 50-50 split and register. You must elect to use those methods. So you, as an employer, you must sign an election form and keep it on file. None of the three exemptions I mentioned for the actual method is available for these two methods. And thirdly, it must be based on your total costs, including those client costs. So we're applying 50% to the total costs or the 12-week register percentage to the total costs. Okay, so just make sure of all of that. Now, just to finish off this area, and this is important for clients who are income tax exempt bodies, there is a special section or category in the Act that relates to income tax exempt entertainment, okay, and there are special rules that apply to those. Now, that's beyond the scope of this presentation today, but if you are a client who is income tax exempt and you want further information, I would suggest you contact Pitcher Partners.
Peejade, we spoke last year about the Toowoomba case and the car parking benefits in that case. Can you please give us a bit of an update as to where that's landed and why employers should still take note of what the decision is there?
Sure, Ali. So just as a bit of a recap, the federal court originally found that the Toowoomba shopping centre car park was not to be a commercial parking station for FBT purposes, even though it charged fees and it was located in the CBD location. In that case, the court basically found that the car park was used as a support to the shopping centre rather than a standalone profit-making business. Now, what's happened since then is that the ATO has appealed that decision to the full federal court. That was back in November last year. We are still waiting for an outcome. A decision should be imminent. And I think from an employer's perspective, this is a highly anticipated decision because it really narrows the focus of what's meant to be a commercial parking station. And should the ATO loses the appeal, there may be an opportunity to revisit the benefits that's been provided by employers, especially those in the urban, just outside of the CBD area.
So it's not ideal then to have that level of uncertainty, the ATO appealing the decision, hanging over employers. what do you think employers should be doing in practice, in that interim period until the final decision's handed down?
Yeah, that's right, Ali. It's certainly not ideal at this point in time, especially we're now entering into compliance season. The only way that the employers can move forward at this point in time is to adopt ATO's current view. The ATO, in its ruling, TR 2021/2, has been fairly clear in terms of setting out the criteria of what constitutes a car parking fringe benefit. Secondly, after the Toowoomba case, the original decision, in terms of the original decision, the ATO has issued an interim decision impact statement, which basically says that it's business as usual. So from an employer's perspective, it is following the legislation as it stands, as well as the views put out by the Commissioner of Taxation. Having said that, we have seen that in areas adjacent to the CBD, there's been some fluctuations in terms of the car parking rates. And so I think it is actually a good opportunity for employers to recheck a couple of things. One, in terms of the rates that's been applied by the car park providers, and see whether they still give rise to a car parking fringe benefit, or otherwise have a look at some of the exemptions in place, whether they actually still qualify for it, or whether they will now qualify towards those exemptions, to make sure to see whether there are ways to manage the car parking fringe benefit liability.
So Gary, as you mentioned earlier, there are two main ways the taxable value of a fringe benefit can be reduced. The first is under the otherwise deductible rule, and secondly through employee contributions. Mm-hmm. Can you provide a little bit more explanation about how the otherwise deductible rule works for the benefit of our clients?
Yeah, thank you, Ali. Basically, the otherwise deductible rule is a hypothetical test. So essentially what we're saying is if the employee had incurred the costs of a benefit and not been reimbursed by the employer, what tax deduction would they have been able to claim? Okay, and to the extent they can claim a tax deduction, we can reduce the taxable value. Now, just a couple of points to note about that though. Firstly, it's got to be a once-only tax deduction. So it doesn't apply to certain types of deductions for, say, depreciation, prepayments, or borrowing expenses, which typically will be, the deductions will be spread over more than 1 year. So they don't qualify as a once-only deduction. So therefore, say if you gave someone a property benefit worth $5,000, you couldn't use the otherwise deductible rule to reduce it based on depreciation. Okay, the second point to note is in relation to benefits provided to associates or shared benefits between employees and associates. Basically, the only otherwise deductible rule only applies to a hypothetical deduction that an employee would be able to claim for themselves. Any deduction in relation to the associate's share is not applicable, does not reduce the taxable value. So a good example might be where an employer gives an employee and his associate a loan and they use that loan for investment purposes. The otherwise deductible rule would only allow a deduction in relation to the employee's side of the costs. Okay.
Understand.
Yeah.
Understand.
Okay.
And the other aspect where taxable value can be reduced obviously relates to employee contributions. Can you explain a little bit more about how they can be used?
Okay, well, employee recipient contributions or recipient's rent is another one, terms under the Act. But essentially what it means is that the employee makes a contribution towards the value of the benefit, so reduces the taxable value. Now, there are three ways to do that. The first one is a direct contribution by the employee to the employer, and that will usually be in the form of an after-tax deduction from the employee's salary. Okay, and the common example of that is cars under a novated lease, which are packaged. Often there'll be post-tax employee contributions to reduce the taxable value to nil. The second type of contribution is an indirect contribution to a third party. And that might be such as an employee purchasing fuel for a car. Now, obviously, they've made a payment to a third party, but if that's not reimbursed by the employer, that can be applied to reduce the taxable value of a car benefit. The third way is via journal entries. So we make a contribution or we journalise a contribution in relation to a benefit that will reduce the taxable value to the extent of that contribution. Now, we'll talk about that shortly in more detail because the ATO has certain rules that need to be followed in order for that to apply. Okay. Now, there are just two other points I'd like to add in relation to employee contributions. Firstly, if a direct contribution is made by the employee to the employer, or a contribution is made by a journal entry, then the amount of those contributions will constitute assessable income for the employer. And that needs to be declared on the income tax return because that is definitely a focus of the ATO, that where they're seeing contributions on the FBT return, they want to see corresponding income in the income tax return of the employer. The second one is any employee contribution, direct contribution or journal entry triggers a GST liability, equivalent to 1/11th of that contribution. And again, that needs to be applied in the usual manner as with GST liabilities.
Great. And look, in my experience, you know, the corresponding journal entry to reflect the employee contribution as income and the GST on that have been a little bit of a watch out, and it doesn't surprise me that it's an area of ATO focus. Yep. Now, again, the ATO has been focusing not just on that, but also on the journal entries to make sure that they comply with what they expect. So what do they expect to see in terms of journal entries to make sure that it's all...
Yeah, thanks again, Ali. That's probably an area of some abuse by employers, making entries far too late or not documenting them correctly. But there's basically three things that must be satisfied. And this comes under a miscellaneous taxation ruling, MT 2050. Okay, and so there's three things. Firstly, we want to establish that there's an obligation on the employee to contribute an amount in relation to a fringe benefit. Secondly, we want to establish that the employer has an obligation to make a payment to the employee, and that could be salary, bonus, reimbursement, or whatever. And thirdly, that there is a mutual agreement whereby the employer and the employee agree that a fringe benefit will be provided in lieu of that commitment by the employer, and the employee will make a payment in relation to that fringe benefit. Now, the thing about all of that too is that it should be documented. The parties should exchange letters, and they need to do that by the 31st of March. And then a journal entry needs to be made by finalisation of the accounts for the income tax return. So by the time they're finalised for income tax purposes, the journal entry needs to have been made.
And I know I'm keep referring back to you and I'm being a little bit alarmist here, but in my experience, record keeping is a significant issue in relation to FBT and for our clients, and can cause major problems. Can you also talk to your experience in this area?
Yeah, it is a serious issue, Ali, in relation to audits and reviews by the ATO. We try to give as much support as we can to an employer during an audit or review, but ultimately, if the records aren't there, there will be issues, and the employer could be assessed. So, for instance, there's no election to use the 50-50 split method, or there's no election for operating cost method for cars. So, what we're really saying is good records pay off.
And so is there anything simple or any key things that employers should be doing to avoid some of these problems we're talking about?
Yeah, well, there's probably a few things. Firstly, all declarations and elections that need to be made are completed and on file by lodgement date of the return. So that's the first thing. In some cases, declarations may not be needed, and we'll talk about that later. But if there are declarations and elections required, complete them and put them on the file by lodgement date. Okay, secondly, things like logbooks are fully completed and copies held by the employer on file. I've had cases where employers, they've relied on the operating cost method for cars, but they don't have a copy of the logbook, and the employee has since departed, so they can't substantiate whatever percentage has been applied. Now, the third thing is things like worksheets, supporting documents like invoices and receipts, and other correspondence between employer and employee, for instance, or like the journal entry, the mutual obligations there for contributions. All of those things need to be kept on file by the time of lodgement as well. Okay? Now, the other thing to note is that records need to be kept for 5 years. So that's a required period. So make sure that they're in a good place and well kept for that 5-year period.
Yeah, we're focusing a lot on record keeping, but in 2024, the Commissioner released a legislative instrument that was aimed at reducing record keeping requirements through alternative records. So what does that mean in practice?
Well, what it's essentially saying is that you can use alternatives to the traditional forms of records that should be kept for FBT. For instance, you may not have kept a travel diary, but the ATO is now saying you can use the itinerary that was kept, say, on electronically on Outlook, to use that in lieu of that diary. So long as it's got sufficient information there to establish where they're travelling, what was the purpose of the travel, etc. It might also replace certain declarations by employees, say for otherwise deductible benefits. So, for instance, a mobile phone or an internet costs. So you may not have got the employee to do a declaration, but what you do get is an email from the employee to say, my business use was 50%, and for these particular reasons, that the purpose of the business use. Okay, so these alternatives are very helpful, but they're also only limited to certain types of benefits. Okay, and that is in lieu of travel diaries, living away from home allowances. There's some concessions there in terms of some declarations. Otherwise, deductible benefits, certain ones for expense, property or residual benefits, relocation and remote area benefits. And yeah, so just basically those areas are the only ones covered. Now, it's probably important to note, Ali, as well, that these alternative records don't replace the certain records like logbooks and certain employer elections that are required. And also, it doesn't mean you can reduce the level of information that has to be held. It's just that you can use a different form. So, i.e. what you already kept anyway, rather than these things like declarations or a travel diary. So, but in the end, the ATO must be reasonably satisfied with the information that it meets their evidentiary requirements.
Not to pick on you, Gary, but earlier you did.
I feel like you are actually.
You did mention that someone can still be treated as an employee even if they're not paid a salary or wage, and this comes up a lot for our clients, especially family businesses where the owners or family members work in the business and receive benefits.
Yep.
Can you give us a sense of where things currently stand? And I'm aware of a particular case two that's been litigated in this area.
Yeah, for sure I can. It's probably an area that really requires close attention, and many of our clients will have these types of issues. Okay, so our clients, private companies where there's a family business, some of the family members are involved. They may not get a salary, but they may get benefits. So really, we have to look at this in more detail. So it does, and I should point out before I go into some of the technicalities, this does raise red flags for the ATO as well. So things like if you've got luxury cars, for instance, that are being leased, they may then look to the company that's leasing them and see whether or not any benefits have been declared for FBT, because often those luxury cars are leased for the use by the owners in the business. Okay, so when we look at this, there's two real considerations with the family members. Firstly, are the family members considered to be employees of the business? Okay, now when we look at that, we'll look at things like, do they regularly perform duties within the business? Do they have a defined role within the business? Do they work regular hours within the business? Okay, if that is the case, then potentially there will be a risk that they're an employee. Okay, and if they receive benefits, then we need to drill down a bit further. Okay, so the second question is whether or not those benefits are provided in respect of employment. You know, it gets back to that fundamental question, is a benefit provided in respect of employment? Now, it becomes a little bit blurred with family members because obviously they could use assets held by their company, for instance, and use them for other purposes other than in the business. But it might also be the case that they have assets within the company, like a car, that is used both privately and also as part of the business. Okay, so when we look at when a benefit is provided in respect of employment, what we do need to establish is whether or not, again, there is sufficient and material connection between employment and the provision of that benefit. Now, so we're asking basically, did that family member receive the benefit because of their employment, or did they receive it for other reasons? Or was it partly because of employment and partly because of other reasons? Now, even if it's only partly because of employment, the Act will deem that the benefit has been provided solely because of employment, and it'll be subject to tax.
Oh, and look, you and I have been having a lot of discussion on this point, particularly off camera.
Yep.
And I did mention there's been some recent court activity in this space.
Yep.
The SEPL case, for example, that's attracted a lot of attention. Could you talk a little bit about what the court said there?
Yep. So that case, a decision of the federal court, and basically it involved three brothers who had hands-on roles in a family business, and they were also had access to luxury cars that were held by the trust. So the business was run by a corporate trustee on behalf of the trust. These three brothers were directors of the corporate trustee, and they were beneficiaries of the trust. So there were these luxury cars, and in fact there were more than 40 luxury cars held by the trust, or the corporate trustee on behalf of the trust, if we want to be technically precise. But so there's these more than 40 vehicles, and they were using those both to do their business work, these brothers, as well as privately. Now, the brothers argued and didn't want to pay FBT on this, and obviously that's the reason for the case, on the basis that the only reason they had access to those cars was because they were directors and beneficiaries of the trust, and it had nothing to do with employment. Okay, the fact they used it as part of employment was really irrelevant to the whole matter. However, the federal court determined that no, you can't unlink or dissociate the use of the cars from the fact that they were used in the business and that they were employees of that business effectively. Okay, so the court basically said that they were provided, or the cars were provided to the brothers in respect of employment, whether solely or partly, and therefore they were subject to FBT. Now, this decision basically overturned an earlier tribunal decision, BKQD, as it was known, which had found in favour of the brothers. But the Sepal case overturns that. Now, it is now subject to another appeal. I think this Sepal case was heard mid-last year. The appeal hasn't, at this point, been finalised. Around this time it may be heard, but it's going to be a number of months before any decision is made on appeal to the full federal court. But in the meantime, I think if you've got any clients, if you're a client with benefits being provided to family members which aren't being declared for FBT, it's probably a good thing to do something about it and have it properly reviewed. And in my view, you should be seeking professional advice on that because it's not a simple matter.
Yeah, no, thank you, Gary.
Yep.
And we might move over to Elena now. And Elena, one of the other areas that we've had a little bit of client queries and client concerns relates to reportable fringe benefits, particularly with some of the exemptions like EVs and so forth. So what are some of the things that employers need to remember about reportable fringe benefits for this upcoming year?
Thank you, Ali. The benefits with total taxable values of greater than 2,000 in the FBT year should be grossed up using type 2 rate and should be reported on the employee's payment summaries via single touch payroll. These reportable benefits may affect employees' entitlements to various government benefits and subsidies, such as, for example, childcare subsidy. However, not all benefits are reportable. Most common exclusions are meal entertainment, car parking, pooled or shared cars, or remote area benefits. In relation to pooled or shared cars, that exclusion only applies to car fringe benefits and does not extend to residual vehicles. A pooled or shared car is a car which is being used by more than one employee in the course of the year. In terms of electric vehicles, they are also reportable, despite that there is no taxable, based on their notional value, and despite that they're exempt from FBT.
Thank you. And another area where you and I have worked quite a bit on in recent times is often there's payroll tax audits or payroll tax reviews initiated by the various state revenue offices, and it's always around, or it's typically centred around reconciling what's been disclosed as taxable wages and what's, the information they've got, what's been disclosed in the FBT return, and there being a bit of a mismatch. Can you clarify how FBT needs to be reported in the annual payroll tax return?
So this area is where we often see errors in payroll tax returns. Basically, all benefits with taxable values should be grossed up using type 2 rate and reported for payroll tax purposes. The common errors we see in this area are when employers forget to include fringe benefits in their payroll tax return, when employers don't gross up correctly using correct rate or using type 1 rate, and also reporting the same amounts as reportable benefits, which they report on the reportable payment summaries. Now, there are two main reasons why you shouldn't report reportable benefits for payroll tax purposes. First, you'll miss out on all meal entertainment, car parking, and shared vehicles. And secondly, you may inadvertently report electric vehicles. Electric vehicles are exempt from FBT, so there is no taxable value to be reported for payroll tax purposes.
Thanks, Elena. So that brings us near the end of our session today. And as we come towards the end, I'd like to personally thank each of Gary, Peejade and Elena for their time and their contributions today. Their depth of experience across FBT and the broader employment taxes really brings these issues to life, and they're really able to explain it in practical day-to-day terms for each of us that we might experience in our business. So I appreciate the time and effort that you've each put into the presentation on the briefing today. Thank you also to everyone that's joined us today, and for the questions raised both during the session and ahead of the session, which we've incorporated into our slides. If we haven't already addressed your questions, please be assured that we will be responding to you shortly afterwards. So once again, we appreciate you taking the time to join us, and we look forward to working with you and your team throughout the FBT year ahead. Thank you.